Mr. C's online classes. Today we're looking at accounting for receivables. So you've heard the term accounting receivables before. We're going to go into a little more depth for that topic. So there are different types of receivables, and you should be familiar with these already. But just to go through them, we've got accounts receivable, and these are amounts owed by customers in relation to the sale of goods and services. There are notes receivable, which is a loan, and these amounts are owed by customers. And the main difference, between accounts receivable and notes receivable is accounts receivables are always made for goods and services, but they're also usually made by either credit or some kind of debit payment, and there's always a fixed duration of around 30 days. So for example, you guys should all have credit cards. I'm not saying you should, but I'm saying I'm sure some of you do. Whenever you make a purchase on credit, the money is transferred from the Visa company or from MasterCard or whatever to the business, to the supplier, and the customer, you, then pay that amount to the credit card company within a 30-day period. And if you don't do that, then you have to pay interest. Now, notes payable is different in the sense that they're not bound to this 30-day period. They're usually a lot longer. The textbook gives a duration of usually between 30 to 90 days, but it can go longer than that. Another big difference is that notes receivables are accompanied by a document that expressly outlines this agreement. For example, when you buy something on a credit card, you don't have to sign any kind of contract or any kind of document. You just use the card and you get a receipt. With notes payable, because the duration is so much longer, there's usually documentation involved where the customer will sign what's called a promissory note that basically says, I will pay you back this amount of money with this amount of interest in this amount of time. And the customer usually signs that. Now, other receivables are for things that are much less common. So there are other receivables like interest receivable and HST receivable, and they're not considered to be accounts receivable or notes receivable, but they operate on a similar principle of a receivable in the sense that it's money that will be paid but hasn't been paid yet. Okay, so the three main issues from an accounting point of view are 1, recognition, 2, valuation, and 3, disposition. And we're going to go through what those are. We're going to start with recognizing AR. Any of you guys watch Big Bang Theory? I always liked Howard. He's an obnoxious character, but he's fun to watch. Recognize. So when can AR be recognized? So recall from the revenue recognition principle that depending on when a sale is made or a service is provided, that's when we record the accounts receivable. We don't record that we actually have the money, we record the transfer under the element accounts receivable. Now, accounts receivable, or AR as it appears here, is a debit account. It's an asset account. And so when we make an entry under accounts receivable, we debit the accounts receivable element, which is an asset account, and we credit sales, which is an owner's equity account. Thus, there's an increase to both sides of the accounting equation, and everything is Humpty Dumpty. So, valuation of accounts receivable. Some accounts receivables or notes receivables won't be collected. Things happen. People go out of business, people get slammed with medical bills. Whatever the reason, to some extent, there is a certain amount of acceptable write-offs, in that businesses go into business with the understanding that sometimes they won't be able to collect all their accounts receivables or notes receivable. It's just part of doing business. It's not good, but it's just the nature of the beast. But as accountants, we need to have methods of dealing with situations like these where we can't collect our debts. And The issue is, what should the accounts receivable value be on the balance sheet when we assume that some accounts receivables will not be collected? So when we go into business knowing that we won't be able to collect all of the amounts of money for our accounts and notes receivables, we need to find a way to represent this information accurately and in a way that provides value for business owners. And we need to be able to accurately track, the accounts receivables that we collect successfully and the amounts that we don't. So for an example, if a business performs a service for $150 on credit on July 1st, at this time we would, and when we have performed that service, that's the important part, when we have performed that service, we would debit the accounts receivable account for $150. We would credit sales revenue for the same amount, and a month would go by, but still no cash is received. So that's the situation. On November 30th, the business completely gives up on collecting this receivable. Now, again, this is just an example. That's not usually how it goes down. There's things that happen in the interim that deal with this, but for the sake of simplicity, we're going through this simple example. So at this point, the business has given up. They've decided they can't recover the $150. So what do? There are two different methods that this can be done. One is what's called the direct write-off, and the other is called the allowance method. And businesses usually want to do this one. Just in summary, this is the really simple method, really easy. The problem is that it's not very accurate. And from a policy point of view, you can only use this method in certain situations. This is more complicated, but it is by far and away the most accurate, reliable, and dependable method of recording these uncollectible accounts receivables. And again, while it is more complicated, it's far more useful. So let's start off with the simple one, the direct write-off method. So when accounts receivable is determined to be uncollectible, whenever that may be, the bad debts account, and we credit the accounts receivable. By the way, I should mention that bad debts is an expense account, so it's in an owner's equity account, and this dash customer here, the reason we put that there is so that we know whenever we're changing the accounts receivables, we know which customer is responsible for the change. So if they pay a certain amount, then we know that we should be expecting money from them. And if they default on their debt, meaning they don't pay it, then we attach this name to it so we know which credit or which amount we're writing off, or which accounts receivable we're not getting. It's just a way to add that much more transparent information to accurately keep track of who's not paying their debts at what time and in what amounts. So, bad debts is an operating expense. Normal balance is a debit because it's an operating expense, but it is an owner's equity account. Under this method, we write off accounts receivable only when we're 100% certain that the collection will not occur. So this is super simple. That's all that's required. But by policy, you have to be 100% certain that the collection will not occur. And thus, bad debt expenses only show actual losses. So you could have, in reality, a lot of customers that are not paying their accounts receivables, but as long as there's even some possibility that they will, we can't write them off. And so I guess an unwanted side effect of this is that we have a big pile of accounts receivables that we probably know we're not going to get paid for, but we can't record it because we're not 100% certain. And that's just tedious for everybody. So by the time you figure out that the accounts receivable is in fact 100% uncollectible, it's often in a different period than the time that you recorded the revenue. And so what that means is that, if you make a whole bunch, and this, I'm interrupting myself. If you go on page 424, there's a really funny diagram. It's illustration 9-1 at the bottom, where there's this guy with balloons, and he's so happy that he's made all of these sales on credit. And so one period looks fantastic because he's made all of these sales, but they're all on credit, they're all accounts receivable, and then the next year, by the time that the company has, I guess, ruled that this debt is 100% uncollectible, it makes the next period look really bad because they're defaulting on a whole bunch of debts. And so the earnings look to be far less than they really are. So, and his balloons all go out and they're all flopping on the ground, and he looks really sad. Anyway, but the main issue here is the relevance and value of the information. Remember, that's one of the things that accountants strive for, is to make their information relevant, accurate, and useful. And if we use a method that makes different things appear to be responsible for problems, and if we're making it look like different periods are worse for the company or better than the company than they actually are, that's a problem. So we shy away from using this method because of that. The fact that it is a poor use of the matching principle, and the fact that it distorts what's actually happening with the company. It makes different things look to be either better or worse than they actually are, which is damaging. And because of all this fog, this metaphorical fog that this easy method creates, we tend to shy away from it. So one more thing is that it also creates an accounts receivable valuation issue on the balance sheet, because a balance sheet is meant to be a snapshot, right? It's meant to be sort of an instant status update. And the problem with this method is that it makes our status updates inaccurate. And if our status updates are inaccurate, what's the point of having the status update? The result of all these problems with the direct write-off method, we tend not to use it. We find that it's not acceptable. So you might be asking, well, Mr. C, if we can't use it, then why the hell did you show us it? Excellent question. Reason number one is that it shows the basic framework for what we need to do to keep track of uncollectible debts. B, it shows us what doesn't work so that we know what does work. And C, it shows us what we need in order to make our tracking method reasonable, accurate, reliable, and useful. So that when I show you what we actually do need to do, you'll understand why we need to take all these steps, and you'll see the value in those steps that we're taking. But that's going to do it for this video. So you're more than welcome to proceed to the first round of homework questions, which are posted on Google Classroom. If you want to keep on going to lesson 2, then that's great. It'll be uploaded fairly soon. But yeah, that's it for lesson 1. I hope you found this useful. Stay tuned for the next lesson on the allowance method. Take care. Stay safe.